Okay, today we are going to compare the FANG stocks, or some of the FANG stocks. Apple, Microsoft, Google, Amazon, Tesla, Netflix, Nvidia, Intel, Cisco and SPY, which is the index to compare them against. The libraries we're using: Performance Analytics, QuantMod, Tidyverse. Now I just run it. We'll get the stocks. From 2018 we'll get the data. We'll see them load down here. There they are. Go back up. We're converting them to daily returns because we want to deal in daily returns, not raw numbers. And here we're omitting blank cells and we're merging the data so that the dates all line up. We're putting column names above them, and here is the chart. Now I'll enlarge that chart. This is a performance summary chart, and we'll just move it over. As you can see from the chart, Nvidia has absolutely skyrocketed since 2023, when ChatGPT was announced and all the associated derivative artificial intelligence products. Make of that what you will. I won't comment. It could go on forever, or it could stabilize, or it could go down. Your guess is as good as anyone's. You can see that's Tesla when it was at the height of the market. It has since faltered a lot, and it's sort of stabilized around return around here. And the others don't look good on this chart compared, because Nvidia has made the scaling of these quite terrible. But if you compare these to the SPY, which I have in another chart, they're actually doing quite well. So that's an example of just how well Nvidia is dominating the market. It's just completely dominating the market. That's not an endorsement to buy it. I'm a contrarian, so I don't follow what everyone else buys anyway. But people who believe in the momentum theory of investing, that's all they do. It's for each individual to make their own choice. You can see that they have quite regular and severe drawdowns. They are very volatile. How can I phrase that better? They are very volatile at all times. And that's exemplified by the daily return. It's quite obviously, big returns up are followed by big returns down, and vice versa. Here we are looking at the standard Sharpe ratio, which most students who've done a finance course and most people who've done a bit of research on the internet know that it's uses the standard deviation as a proxy for risk, divided by the return. And here I've got a chart which scales the risk-return ratio by the performance of the FANGMA associated stocks. They're not all FANG stocks, but they're Closely related. This is Apple, Microsoft, Google, Amazon, Tesla, Netflix, Nvidia, Intel and Cisco. Intel and Cisco are not technically, they're tech stocks, they're not technically FANG stocks. Nvidia is a late arrival to the FANG stocks. It wasn't there till the last few years. Okay, now, Performance Analytics has its own Sharpe index. I'm using F Portfolio for a reason which I'll explain later. It makes things a bit more tricky, but it makes it more interesting. But anyway, to get on with this, I'll just basically run through the chart, and it's not that chart there, that's the wrong one. It looks similar, but Apple should be up here, not down there. And ggplot, combine the tickers, we'll get the symbols, tickers, from Yahoo with QuantMod's get symbols command. We'll look right down here, it'll take a few minutes, a few seconds. Waiting, here we go, we got them, all down here. Now, we want to turn them into daily returns. We use the QuantMod daily return command and the type log. I don't like arithmetic. Arithmetic tends to exaggerate returns. And log is, for quantitative mathematics, it's more malleable and it's a better measure. I won't go into it too deep. I'll leave that for the listeners to sort out for themselves. You can use standard normal arithmetic returns or log returns. It's daily returns we're using. We'll just go through them one by one. That's Apple, that's Microsoft, that's Google, that's Amazon, that's Tesla, that's Netflix, that's Nvidia, that's Intel, that's Cisco. And now we're going to employ the Sharpe ratio. Actually, I was going to do something else here, but I'll just stop it for a moment and add a bit of code to show you why I use the F portfolio Sharpe ratio rather than the standard Performance Analytics or one of the others available. Sharpe, we'll look at Microsoft, that'll do. And that should run. See what we get. Now, you can see it's quirky. That is the annualized standard deviation. That is the traditional Sharpe ratio, which very rarely exceeds 1. It's generally scaled between 0 and 1. It's the standard deviation with the numerator is returns. You can see that Microsoft has a very good standard deviation when it comes to the Sharpe ratio of standard deviation, 0.8, which is very high. However, for those who want to analyse a bit deeper, that's why I use this, we've got the Sharpe ratio on the variance at risk, which is the top 5% of the extreme worst decile, taken from a bell curve. It's not empirically derived, it's just taken straight statistically from a bell curve, the worst 5% of data. And as you can see, it's 8.3. So that implies that the numerator divides many times, or the return divides many times, into a very high variance at risk. So even though it's a good risk-return investment on the standard Sharpe ratio, it's not necessarily giving the variance at risk. But I wouldn't take too much the variance at risk seriously, because it's not empirically derived, whereas the expected shortfall here is an empirically derived variance at risk. It is the top 5% of the worst decile derived from actual data of the share from 2018. And you can see it's still very high. So even though on the standard Sharpe ratio it's a good performer, there is a caveat there in the sense that there is a lot of outliers. It's indicating that it has a lot of outlier events, just to warn you. I'll do one more. A stock I used to invest in years ago was Intel. It's not gone so great lately. Let's see if that's right. Is it Sharpe? No, it didn't. Yeah, I think it's Sharpe. Yeah, we'll see. Yeah, that is, yeah, Intel. You can see Intel's really abysmal performance on the standard deviation measure. It's negative. So that means its risk, its return is negative to start with to its risk. And its risk is very high even to a negative return. So even though it's not so bad for the VAR and the expected shortfall, it doesn't have many extreme tail events. It has negative returns. Now that would require fundamental analysis, of the balance sheet and the financial statements and projections and things. We've not got time to do that here. I'll move on to what the object of the exercise is, to produce the proper chart like this. So I'll move on. We're extracting the annualised Sharpe ratio. We're putting them in a data frame. And now we're going to plot the actual chart. That's the proper chart. You can see Apple, Microsoft and NVIDIA are going gangbusters according to the standard Sharpe ratio. And once again, you can see that the tech stocks, who are not actually FANG stocks, Cisco and Intel are performing very badly. They may be good investment though, but you're not going to get good returns for maybe either till they can catch up with NVIDIA, or Cisco's in the server business. And the server business with cloud hosting by the big companies like Microsoft and Amazon has really been destroyed. That's their problem. Amazon and Microsoft have destroyed their business. And Intel has been largely beaten to the gun by NVIDIA. So that explains their situation. But, Apple, Microsoft and NVIDIA are doing well. And Amazon, Google are doing moderately well. And Netflix and Tesla's on the cusp, it's doing acceptable. Netflix is a bit risky for its return, but still it's in positive territory. I think that's all there is to that. This shows you how you can quickly analyse the Sharpe ratios and things, what you need to know. I think I've extended this video too long, so I'll sign off now. I hope you find it helpful. This is part of a 3 or 4 part series I'm doing over the next few days on not necessarily the FANG stocks, but on tech stocks in general. I'm looking at the QQQ as a proxy for the NASDAQ. because the Nasdaq is performing so amazingly well, because of the FANG stocks, is primarily why I'm looking at it. And also, I'm looking at it for the fact that the FANG stocks are almost 35% of the S&P 500's performance as well. So yeah, really, the whole market, like in 2001 when the big crash arrived in tech stocks, history is repeating. Will they extend or will they regress? Who knows? Anyway, I'll sign off.